So we might not see things get further worse from here, in that we do see the dollar likely remaining strong, but not further accelerating. We also don't see much depreciation either. We think it likely will be range bound. And oil prices as well, we don't really see that much downside. They might not spike further from here, but still remain relatively high. Then the next question is really, what is the fundamental macro backdrop? And say particularly for Asia, and we see global growth turning down, and we see a transition from spending on goods towards services, which as well should probably slow export growth, which has been quite strong still for most Asian economies. And so there are still some headwinds, probably not further worsening, but not yet ready to turn outright positive, particularly with that global growth backdrop, that U.S. growth backdrop and European growth backdrop looking at likely weakening from here.
You know, it's very interesting when you talk about the growth outlook, because at the moment it depends on which asset class you're looking at. But if we just take fixed income for a second, like bond yields and their behavior, they seem to be focusing more on the inflation side, right? I mean, after the FOMC minute, US bond yields rose. After the UK, 40-year high in inflation, gilt yields rose. So I'm just wondering why you are so keen on fixed income as your current highest conviction.
We like particularly the shorter dated, which is, say, less interest rate sensitive, and where we think we already see a lot of hikes in the price. As well, looking at higher quality names within investment grade universe, we see fundamentals quite attractive. And for us, from an investing perspective, it's all relative. And so when we're looking at the relative expected returns of fixed income versus equities, we see current yields as being quite attractive. And particularly looking at the short dated investment grade part of the universe, we see yields there as attractive, and especially relative to our expectations for equity returns. And then so you get relatively similar expected returns, but with better downside protection, with less volatility.
What do you think the Fed's going to do at the September meeting? It seems like at this stage, the Fed funds futures are suggesting a 35% chance of a 75 basis point hike. What do you think they're going to do? And is there the danger of upsetting the apple cart?
Yeah, it seems like it's a toss-up between 50 and 75, and a lot will depend on the data we see between now and then. We will get a number of additional data points, both on the labor market, on the health of the U.S. consumer, and especially on inflation. And it's really hard to predict. We've seen massive volatility in short-term rates. We've seen massive volatility in terms of what's being priced around the Fed meeting. And I know it's cliche to say they will be data dependent, but I think in this environment where it becomes so uncertain and unpredictable, it really will be data dependent. If we see some upside surprise in terms of underlying inflationary pressures, then they certainly could go 75. If not, then 50 becomes more likely.